What is up, you guys? Today we're going to be talking about Alibaba. Alibaba has had a really bad past couple of years. In the past couple of days, it's actually done really well, which is why I decided to start to look into this now that we might be at an attractive valuation. But Alibaba has not really been doing well over the past couple of years. The stock is beaten up significantly over the past years, down 34%, and in the past 5 years, down 53%. But a lot of people are looking at this company as potentially a very strong investment going into 2023 and 2024, as a lot of people think that this company is undervalued. And what we're going to do is look at the income statement, we're going to go over the balance sheet, how does this company make money, go through some estimates of where I think the company could be, and what price I would need to be buying this company at. Make sure you guys hit the like button, subscribe, comment any tickers you want me to go over down in the comment section, and we will go over them if they get enough likes. Make sure you check out our Discord community down below. The link is in the description. You guys will get access to free courses, free live streams, free seminars, free webinars, access to all my long-term trades, and become part of one of the fastest growing Discord trading communities out there. The link is in the description. Taking a look at Alibaba, you all probably know what they do. They are the world's largest e-commerce and mobile commerce company if you measure by gross merchandise volume alone. But they're huge. They're basically the Amazon of China. Jack Ma is the CEO. You guys all probably know that. You've probably heard of Alibaba. You've probably heard of AliExpress. There's other things like Taobao, Tmall, a bunch of other parts that are under this company. A huge part of this company also is their web services department, or what's called Alibaba Cloud, and DingTalk, which is, if you guys know Amazon Web Services, it's along the lines of that. And this company has just really not performed well over the past couple of years. Market cap right now is 230 billion. Price to sales is 1.9, which is very, very cheap. Revenue over the trailing 12 months is 121 billion. Net income is 1.96 billion. The PE past trailing 12 months is 117, but the 5-year PE is 16.85. And as we said, price to sales is very solid as well. Now, one of the things that I will say overall, I don't like to invest in Chinese companies simply because number one, I've been burnt before. I've invested in Luckin Coffee, not pre the craziness that ensued, but I did invest in Luckin Coffee afterwards. But when you look at that as an example for fraud, it's just bad. Neo has been another company that I've been worried about, but the biggest issue that I have is if these companies were to get delisted. It's just not something that I want to deal with, and so I never invest in Chinese companies. Alibaba is one of those companies that I feel that if I were to add specifically a Chinese investment to my portfolio, that I would probably go with Alibaba or Baidu. And to a lot of people, simply, they just don't want to take the risk of potentially getting their stock delisted from the New York Stock Exchange. But looking at this company, there are a lot of good things to it. If we look at the income statement starting out first, one of the things you're going to notice is that they have really good revenue growth. I mean, especially for how big the company is. 2013, 3 billion, 14, 8, followed by 12, followed by 17, 27 million, 43 billion. So in those 5 years, they grew significantly from 3 billion to 40 billion. It's more than 10 times. 2019, 62 billion, 2020, 82 billion, and then we had something happened in 2020 which really helped online revenue, 114 billion in 21 and 121 billion in 2022. So this company was growing very, very strong, and then obviously just from 2019 to 2022 they doubled by something helping that, obviously. Gross profits followed and went up as well, which is really good. And then you can see net operating loss, net operating interest income. Actually, we should just go to net income in general, it'll just be helpful. But if we go to our net income, the past 5 years average is 13 billion, but you can see here that in 2022, not the best. Up until that point, they were doing well, but we started to see them make a little bit less money here in 2021 and in 2020, and then followed subsequently by 2022 not being too hot. Now, looking at the balance sheet, though, something to notice, current total assets is going to be $90 billion, and total assets in general is $239 billion, followed by total liabilities at $86 billion. So something that's really nice is that not only is their total liabilities to total assets double, but it's like basically almost triple. So what's really good is if the company wanted to pay off all debt tomorrow, write a check, it's donezo, which is very nice. And I like to see that because not only does having cash on the balance sheet great for just if you want to pay your debt off really quick, but it's also phenomenal because you can go acquire a ton of companies while the market is getting the crap beaten out of it. And so when you see a stock, unfortunately, the economy going into what's going to seem like a widespread recession, textbook wise, we are there already. You want to see cash on the balance sheet because the company cannot, like I said, not only pay off debt, but it can deal with harder times. And on top of that, you can go acquire smaller companies for pennies on the dollar during a recession. Now let's run this through the stock analyzer tool through Everything Money. I'm not affiliated with them at all. I just really like this platform. Looking at revenue growth, you see it's all over the place. Past 10 years was 42%, 5 years 28%, 1 year is 5%. So we're going to go super conservative, and we're going to say here on the conservative side, 2%. On the mid side, we will say 5%. And on the high side, I will throw 10% out there because it's really not that crazy if you're to remove recent times. Looking at profit margins, right now they're at 1.6%. So we will say 1%. Mid, 15% over 5 years, 21% over 10 years. So mid, I'm just going to go through and say once again 5%. And then high, I'll say 8%. I'm not going to quite say 10. Free cash flow, 11, 21, 25. So we will do 5, we will do 10, and we will end up doing 15. Now, I want you to understand how conservative this is. I'm a real stickler when I'm running this, but with something like Alibaba specifically, I'm going to be even more of a stickler than I normally am because I'm already bringing on a shit ton of risk just by the fact that it's a company in China. Like that's a huge amount of risk. So if the numbers don't make sense with like my really conservative numbers here and my conservative assumptions, then there's just no reason to invest. PE ratio right now is 117. So let's just say we can get PE back down to 15, 20, 25. And then price to free cash flow, let's say that we could do 10, 20, 25. And we want 15% return, obviously. And then analyzing these numbers here, you would see that looking at the high side, anything under 87 right now is a deal. And I'm going to be quite honest. The high side of this, I think, is very possible. But I would not run the numbers based off of that simply because it's just a Chinese company. If we weren't bringing on that risk, then I would be like, those high numbers are not high enough. That's probably would really be mid. But looking at these mid assumptions, the major thing really probably going to be free cash flow and profit margins. But looking at this, you can see here that our analysts are set, like our estimates would be somewhere around $32. So in my opinion, I think it's worth investing because the high side is really not high. That's like mid. I think this company can easily do that on the next 10 years. The issue is that it's just a Chinese company. And honestly, for me personally, I don't want to bring on that type of risk. I really don't. And when you look, I think from here back up to all-time highs would be 260% return. That's freaking nice. But it's just not worth it for me right now. If Alibaba could make its way down to like 50, 40, like we were down trading at 57. I should have probably grabbed some at 57. But if we can get back down to the 50s, I will grab some for sure. But ultimately right now, I'm just not going to be grabbing it. Guys, I hope this video helps. Hit the like button, subscribe. As always, let me know any comments down below or any tickers you want me to talk about. Thank you for all the support, and I'll see you guys tomorrow. Peace.